Hi guys, welcome to the page of Karma Shiksha. Today's topic is depreciation. We will start with discussing what is fixed asset. Fixed asset is something that is owned by the business. It is used in business for generating income. It has long-term use and can be used in the business for more than 1 year. The useful life of fixed asset can be estimated and the fixed assets appear in the balance sheet. Fixed assets are further divided into two types, tangible and intangible. Tangible assets are those which have physical presence against intangible assets which are not physically present. Some examples of tangible assets are building, machinery, vehicles, furniture and fixtures, computers and equipment, etc. For intangible assets, some examples are brand, licenses, trademark, patents, copyrights, software, etc. Copyrights and software. Now let's discuss depreciation. Depreciation means reduction in the value of fixed assets in our books. Depreciation is calculated on the written down value of block of assets. Written down value means the value at which assets are shown in the balance sheet. Block of asset means a group of assets which are of the same class. So basically, depreciation means calculating the value of use of an asset in the current year and transferring it from the balance sheet to the profit and loss account. An exception of depreciation is land. Although land is a fixed asset, but no depreciation is charged on land. Now let's move on to the depreciation rates of various fixed assets as per the Indian Income Tax Act 1961. Let's start with the depreciation rates of building. We'll divide buildings into three parts. The first being residential purpose buildings except for hotels and boarding houses. These are depreciated at 5%. Any building which forms part of water supply projects, water treatment systems and are put to use for providing infrastructure facilities under Section 80IA and temporary erections like wooden structures are depreciated at the rate of 40%. Any other building apart from these two are depreciated at the rate of 10%. Let's move on to furniture and fixtures now. All the fittings including electrical fittings are also included in this category. The depreciation rate for this is 10%. Moving on to plant and machineries. Plant and machinery are depreciated at the rate of 15%. Plants used in semiconductor industries are depreciated at 30%, and some plants that are used in weaving processing and garment sector of textile industries are depreciated at the rate of 40%. The next category is motor cars used in the business for other than running them on hire. Motor cars acquired after 23rd August 2019 are depreciated at the rate of 30%. Any motor car acquired before that is depreciated at 15%. Aeroplanes and aero engines are depreciated at 40%, whereas ships are depreciated at 20%. Motor buses and lorries which are used for running them on hire are depreciated at 30% and others are depreciated at 45%. Commercial vehicles fall under the category of 40% depreciation. Pollution control equipments for water, solid waste and air along with life-saving medical equipments are depreciated at 40% rate. Books fall under the category of 40% and computers including computer software also fall under the category of 40%. Intangible assets are depreciated at 25%. In case of machineries used for industrial undertakings and power generation business, an additional depreciation of 20% is provided. In case the asset is used for less than 180 days, half of the depreciation can be claimed in the next year. The last topic of this video is unabsorbed depreciation. If a company faces the situation of losses in any year, or if the profits are not sufficient to write off the entire depreciation, it can be forwarded to become the depreciation of next year. Unabsorbed depreciation can be forwarded for infinite number of years and it can be adjusted from any head of income. With this, we come to the end of this video. If you liked it, please subscribe, like and share. You can also follow us on Instagram for regular updates. Thank you.